two of the leading experts on insurance in the nation, Doug Heller and Michael DeLong, fight the good fight for policyholders at the Consumer Federation of America. The insurance industry has created a crisis of its own making, jacking up rates and threatening to pull out of markets. We are glad to talk with them about the causes and solutions. I'm Ware Wendell. This is Doug Heller and Michael DeLong in conversation. Doug Heller and Michael DeLong, thank you for joining us on In Conversation.
Glad to be here. Thanks, Ware.
You both are two of the leading experts in the country when it comes to insurance. And I want to focus this conversation on homeowners insurance and auto insurance, the types of insurance that, just about everybody has to have these days. And we'll talk about how hard it is to get some of those lines of insurance because of the cost. But Doug, you're the director of insurance for the Consumer Federation of America. Michael, you're the research and advocacy associate at CFA. Just for full disclosure, Texas Watch is a member of the Consumer Federation of America. I see the CFA as being the leading consumer group in the country. Y'all do amazing work. Doug, could you talk a bit about the history of CFA?
Well, sure. Thanks so much for having us, Ware. CFA has been around since 1968 as really one of the leading consumer organizations focused on research, education, and advocacy around a whole range of consumer issues, a lot of pocketbook issues related to banking, and product safety, and also insurance. And we've been working on insurance for a long time. Our original director of insurance was a former Texas insurance commissioner, Bob Hunter, who recently retired. But for over 50 years, we have been one of the leading voices in the country. And what's special about Consumer Federation of America is that we're a membership organization built of groups around the country, state, local, and national groups, all of which are doing consumer protection work in various areas, both different issue areas and different regional areas. And because of that kind of association nature that we have, we really get a perspective of what's happening across the country in such a range of consumer issues that we've become a real center point for the discussion of consumer issues and consumer protection all around the country.
I think that perspective is so important. You really do get the national perspective because you're constantly working with groups on the ground in different states. And then just the professionalism of CFA, you all have the subject matter experts on a wide range of consumer issues. So we look to CFA for your leadership, and we thank you for your time today and talking with us about this insurance crisis that we're seeing across the country. I see it as an insurance crisis largely of the insurance industry's own making. We're seeing insurance companies, especially on the homeowners side, threatening to pull out of states or pulling out of markets. And then on the auto side, we're seeing rate increases that will just make your eyes water. That's happening to us here in Texas. The rate increases both on the homeowner side and on the auto side are twice the national average. That's hitting Texans in their pocketbook where they can least afford it right now as they're trying to balance their family budgets around kitchen tables all across the state. But Doug, can you start by telling us what you're seeing across the country in terms of the insurance industry and what's happening with rates and coverage all across the country?
Well, yeah, you set it up exactly right. This is an unprecedented era of rate increases and diminished access to the marketplace for Americans all around the country. It is not, if you read the news and pay attention to insurance issues, you may think that there's a problem in Florida and in California, maybe a little Louisiana sprinkled in there. But in fact, the insurance crisis has swept across the country. And we are seeing dramatic rate increases and diminished availability really in every state. And this is something we're hearing from consumers all around the country who are having these sort of nervous conversations about whether or not they're going to be able to have their home insured or afford their auto insurance. And we're seeing people reduce the coverage they have for auto insurance. We're really concerned about an increase in uninsured drivers and also uninsured homes because of this crisis. And it is kind of a confluence of things. You, I think, led off with the very critical point, which is the insurance industry, despite the fact that it's supposed to be regulated by every state, has really been able to get away with whatever it wants around the country. And that means increasing rates, diminishing the quality of coverage, and diminishing the availability of coverage. So that's one key factor. But another important factor is that climate change has been increasing the risk of loss. I mean, this is a reality that we have to face. Over the last many decades, we have increasingly done damage to our climate in such a way that is causing more storms, more wildfires, more and larger hail to do damage, right? It's across the country. These crises, these floods and other sort of catastrophic perils are showing up in more frequently and more severely. And then a third piece of this, which I think is a really important and connected part, is that our insurance markets, especially property insurance like home insurance, relies heavily on an unregulated global reinsurance market. This is the insurance product that the insurance companies themselves buy to hedge their own exposure. This is the way that they kind of offload some of their risk. But that unregulated global market, that is a market that is controlled by companies that can take their capital anywhere around the globe to find the best profits. And we in the United States are paying huge sums because of that. It is a seller's market, and those companies based in Bermuda and Switzerland are taking full advantage of the crisis here in the United States. And that's another part of this three-legged stool between climate, reinsurance, and just weakly regulated insurance companies that is really hitting us all in the pocketbook.
Reinsurance is a big piece of the puzzle. That's the insurance that insurance companies buy. And it's foreign insurance companies that are jacking up their rates and then passing on those costs to Americans. And we're certainly feeling it here in Texas. I want to talk about a solution to that problem here in a bit. You mentioned climate. I can tell you, and Doug, you well know, having worked on this issue for decades, we have been raising this issue for the insurance industry for 20 years now, that the climate is changing. We are dealing with more frequent and more severe storms. Here in Texas, the Texas Panhandle just suffered the largest wildfire in the state's history. Over 1 million acres were burned. Massive claims coming out of that. On our coastline, it's very hard to get windstorm insurance. You're left to the insurance company of last resort, which is the Texas Windstorm Insurance Association. In 2017, the insurance industry rammed through a bill that we fought against that makes it much harder to take your insurance company to court if they wrongfully deny or underpay your weather or storm-related property insurance claim. So you have less legal rights. You're going to have a harder time finding an attorney to help you if the insurance company and their army of lawyers are wrongfully denying your claim. So we're in a bad situation here in Texas, but I know that that's the case across the country. Michael, I know you focus a lot on auto insurance. What are you seeing in the auto insurance market right now in terms of rate increases, coverage that's provided or taken away from consumers? Bring us up to speed on what's happening with auto insurance.
Well, with regard to auto insurance, we're seeing big rate increases across the board in almost every state. They vary widely depending on the state to which they happen, but we're seeing rate increases of like 10%, 15%, 20%, sometimes or more. And the companies are citing a whole bunch of reasons to justify this. Like they say, among other things, that the cost of labor and parts has increased, which in many cases is true. They're also saying that some people are worse drivers, which again, in some cases is true. But another big factor is that the companies have done a very bad job of managing their sort of finances and other things. You may remember during the COVID-19 pandemic, when there was everyone was staying at home because of stay-at-home orders, there was a huge decline in miles traveled, crashes, and claims filed. So auto insurers reaped utterly gigantic profits. Now, in response to public pressure from us and other consumer advocates, they gave back some of those profits in the form of premium refunds, but they didn't give back anywhere near enough. They took that, and instead of investing it wisely or doing something else smart with it, they gave their CEOs and shareholders enormous bonuses and rewards. So they were also caught by surprise when there was inflation and things rebounded. And also, the insurance companies, frankly, they're greedy. They want to make substantial profits. In many states, insurance regulators either are kind of captured by the insurance industry, or they can get away, or they don't really view protecting consumers as a high priority. And so insurance companies are asking for these big rate increases, and they're getting them in a lot of cases.
I'm really glad that you mentioned insurance company financial practices. And CFA produced a blockbuster report on that insurance company executive pay and just how they feathered their own nests. CEOs were making huge salaries, huge bonuses. And I think it's important for the audience to remember insurance is not a typical product. It's not a typical commodity, like if you're deciding to buy a new television set or to make do with your old television set. We are forced to buy these products. If you're going to drive on the roads legally in Texas, you have to buy an auto insurance policy. And if you've got a mortgage on your home, your bank, your lender is going to force you to have an insurance policy for that home. And if you can't get one yourself, they're going to buy one and force it on you. It's called forced place insurance. Mm-hmm. And so this is not a free market. You can't choose to go without these products. The demand curve is really set for these products artificially. Economists would call it inelastic demand. And so it's not as sensitive to supply and demand as other products. And that's why we need regulators. We need folks to oversee this area of the economy to make sure that we as consumers are not being taken advantage of, and that the insurance companies are just taking all these premiums that they take from us every month as they charge us for their product and paying it back to themselves in the form of big bonuses and big salaries, which we saw happening because you all quantified that in your report. We're going to make sure that we include that report in our show notes so that everybody who sees this interview can see just how many millions of dollars these CEOs were making in these insurance companies. But it was shameful the way that they were profiting off of all of our backs.
Yeah,
Doug, please.
Just very briefly, because you made a point about the demand curve, and I think it's always interesting to me as somebody who spends a lot of time in legislative settings around the country, and also in the kind of the discussions around, well, should we be regulating this industry more or less? For some reason, so many lawmakers who will speak out against regulation as burdensome never have a problem with the regulation of us, the consumer. As you described it, the demand side of the insurance market is very much regulated because we are required by law to buy this product. So if lawmakers are so comfortable regulating us, why won't they stand up for us and make sure that the insurers who we have to buy from are subject to some rules, some oversight that will ensure that we have access to a fairly priced product, because that's what we're getting. As Michael described, the incredible bonuses that were paid to these insurance executives in the wake of kind of the worst crisis in a generation in America with the pandemic, with State Farm's CEO getting a $10 million increase in his salary, doubling of his salary in 2020, the very year of the pandemic. And shareholders seeing the biggest kind of dividends and special dividends paid out. And also the insurance companies used all of that premium or so much of that cash that they got during the pandemic when they didn't have to pay claims to go consolidate their market. So for the first time in its corporate history, State Farm bought another insurance company, Liberty Mutual bought an insurance company. Allstate bought two companies right in the wake of the pandemic and mostly with cash, because they were so flush with it. How instead of what they ought to have done, which is either refunded it to us because we were overpaying when we were stuck at home, or at least used it to help calm the waters as we came out of the pandemic. And instead, the insurance companies used that cash for their own interests. And the moment that they saw a little inflation as the economy began to rebound, they came right back at us with these higher and higher rates. And so they used the excuse of inflation for a while because we did have things like the supply chain issues and higher labor costs and costs for replacement vehicles and things like that, cost of steel. But as the inflation curve has come down, the insurance companies have remained sort of on the other side of the inflation curve. They're still stuck in 2022 and 2023 saying, oh, well, we've got to be pricing insurance as though we're having 9% inflation still. They like it back there being behind the curve because that's good for their premiums and their profits. But for the rest of us who are really forced to buy this product, it's just outrageous that our regulators haven't stepped in and say, no, you can't do this. You can't price us as though we're going to be stuck in that kind of 2022, early 2023 inflation bubble forever. But that's what's happening for the next 6 months, 12 months, probably 18 months. We're going to be seeing old inflation numbers impacting the premiums that we pay, even as inflation has moderated. And that's really kind of goes to the whole story here, which is the insurance industry, they are always slow to lower rates when things are going well, but they are quick to raise rates the moment there's a little bit of tightness in their market. And the regulators in Texas and around the country kind of just open the gates for them. Whatever they need, they get.
That was very well said, Doug. You're exactly right. I mean, the insurance industry profited off of the pandemic while all of us were catching hell. People's, personal finances were decimated. A lot of people lost jobs, trying to figure out how we're going to put food on the table. The insurance companies are profiting while we're stuck at home in lockdown. And then coming out of it, they've not managed it well at all. And they're exploiting this own crisis of their own making. They've never met a crisis they didn't like or that they couldn't exploit through their lobbyists. And so I was talking about the great report that y'all did on the CEO. I don't even know the right word to talk about the obscene, the excessive bonuses that they all received. But then the latest report from CFA is even more telling in many ways. It's called Exposed. And Doug, you and Michael and your director of housing, Dr. Sharon Cornelissen, authored the Exposed report that really looks at the crisis right now for homeowners and even obtaining homeowners insurance. Just some of the top line figures out of that report. 1 in 13 homeowners in the country right now are uninsured. That amounts to over 6 million homeowners in this country. If you have a household income of $50,000, you're twice as likely to be without insurance for your home. You've seen issues in rural America, but also in urban areas like Houston. It's huge, and it amounts to, is it $1.6 trillion in property wealth right now that's bare, that's subject to losses, whether it's an electrical fire in your home or tornado hitting your home, whatever the issue is. A lot of people are being forced to go bare. Michael, I know that you know a lot about the particulars of that policy report. Can you talk a bit more about that?
Yeah, of course. We realized that homeowners insurance and the lack of it is a very serious problem. And me, Doug, and Sharon, the three of us collaborated on this report. Sharon did some fantastic research. Doug did some fantastic research as well. And we wanted to ask some questions like, who actually lacks homeowners insurance? Which households? What is their housing like? What are their demographics? So we did a study. We analyzed a whole bunch of data from the American Housing Survey and the American Community Survey. We weighted the responses to make sure everything was representative. And what we found was pretty appalling. You already mentioned that one of our chief findings was that 6.1 million homeowners lack homeowners insurance coverage. That's 7.4% of homeowners, or 1 in 13 of American homeowners. And if you lack homeowners insurance, you're completely on the hook if your home gets damaged or destroyed or something else. You have to pay for that out of pocket. The Federal Emergency Management Administration, in some cases, if there's a disaster declaration, they might give you some money, but their maximum is, I believe, about $40,000. And in most cases, it's a lot lower than that, only a few $1,000s, but there's nowhere near enough to cover it. And so we also found that lower valued homes, homes valued at $150,000 or less, they're most likely to lack insurance. And these homes tend to be owned by people who are disproportionately likely to live in poverty. And so, again, the people who can afford the least to lose things, they're actually paying more. We also found some things. Owners of manufactured homes are very likely to not have homeowners insurance as well. We found that an astonishing 35% of owners of manufactured homes don't have homeowners insurance. We found that about 22% of people living in poverty lack homeowners insurance. So again, if you're poor, you're at greater risk of losing everything. We found that Black and Hispanic homeowners are more likely to lack homeowners insurance. We found that an astonishing about 22% of Native American homeowners lack homeowners insurance. So this is a especially big problem there. We also found that there are certain areas where people lack homeowners insurance. They're more likely to lack homeowners insurance, certain metropolitan areas. And two of those areas are actually in Texas. In Dallas, we found that about 5% of folks lack homeowners insurance. And in Houston, we found that 10% of folks lack homeowners insurance. But so those are especially serious problems, especially because with the rise of climate change, it's resulting in more risk. You see more frequent natural disasters, you see stronger hurricanes, you see a longer wildfire season, you see all sorts of extreme weather conditions and storms. And so Texas is especially at risk. And it's not just limited to those areas, all Dallas and Houston, although it's especially serious problem there. The lack of homeowners insurance is a problem across Texas and across the country. So people shouldn't feel, elected leaders shouldn't feel smug by saying, oh, my town is not on this list, therefore everything is perfectly fine. No, homeowners insurance, the lack of homeowners insurance is a big problem and it needs to be addressed. We concluded with a few recommendations. We said that basically to state insurance departments, you folks need to collect more data and track the affordability of homeowners insurance and also look at inequality in this area. We say that you all need to invest in risk reduction through mitigation measures. You can save a lot of money if you make your home stronger against hurricanes, or if you clear the brush around your home and take measures to protect against wildfires. We talked a little bit about a possible mechanism to bring down reinsurance costs. And we also called for them to do additional reinsurance on racism in homeowners insurance and the gap there.
I'm really glad that you all looked at low-income housing because, Texas has a booming economy. We have for years. We will hopefully forever in the state of Texas. And the people who are building the buildings all across the state and building the houses all across the state, and the people washing the dishes in the restaurants, and you name it, all of those service workers, whether they're living in low-income housing, manufactured housing, they're getting it the worst is what your report quantifies and shows. Doug, what would you add to that?
Yeah, well, a couple of things. First, an important caveat to our report, which is we were using the most recent available data, which was 2021 data. We're going to be doing a renewing of that report once the 2023 housing survey data come out. And we're deeply concerned that it's going to reflect what we all know to be the pain of these rate increases that have happened since 2021, and that we're going to actually see an increase in the number of uninsured homes. So we think that this is the low watermark for it, and it's only going to rise in terms of the number of uninsured homes. So we're really worried about seeing the new data. Of course, we need to see it. We need to understand how severe this is. You pointed out earlier that if you're uninsured but you have a loan, your insurance company is going to go buy an insurance product that only protects them, and then they're going to make you pay for it either in your mortgage escrow account or on your mortgage payment. So we're talking with these 6 million homes, we're talking about homes that the people own it outright, sometimes because they've owned it for a long time, other times because it was passed on from generation to generation. And in lower income communities, homeownership is often the sort of sole source of wealth and the ability to pass wealth on from generation to generation. But because of the insurance crisis in America, because of the failure of our regulators to stand up to the companies and protect consumers and make sure there's a quality product that's affordable, we are finding that sliver of opportunity, that chance to pass wealth on from family to family, generation to generation, is being taken away from our most vulnerable Americans because they simply can't get the coverage they need. And they're just one moment, one spark, one bad storm away from losing everything. And so we are, so that caveat that the data may be actually worse than we've even been able to see is really important. But I wanted to also make another note, because we only are talking about home ownership. Now, for the majority of low income and even moderate income Americans, they don't even own a home, right? They're in a rental unit, maybe in an affordable housing unit. And one of the things that we are seeing of critical concern right now is just a terrible market for those affordable housing developers, community development organizations that are building the units that provide affordable housing across Texas and across the country. And so what we're seeing in that market is insurance premiums that are going up not 11% or 20%, but 50, 100, and 200%. We're seeing a reduced availability. So the market is shrinking for those community development organizations. And then they're facing other pricing things like crime scores by insurance companies that say, well, if we have a high crime score in the neighborhood in which you're building this low income housing, we're not even going to make a policy available to you. If you have folks that use Section 8 vouchers, we're not going to make a policy available to you. So we see these really biased and discriminatory practices that are making it even more difficult to produce the kind of affordable housing that are necessary to keep the economy going. And so I think that is, as much as we focused in our research on the homeowner side of it, we have to recognize that this is a crisis that crosses all sorts of housing, manufactured housing, single family homes, multifamily units, affordable housing. Every piece of the housing puzzle is being impacted by the crisis on the insurance side. And so when we talk about national economic issues, we think about systemic risk. What could pose a real risk to the system, the financial system? We remember the 2008 financial collapse. Well, in 2024, the insurance market is creating systemic risk to our housing system. And so I think that is absolutely incredibly important that, well, you are paying attention to this, that the legislatures around the country start putting in focus the problems of insurance prices that are out of control, and make sure that we are working harder to make availability a real priority for our communities.
Those are such important points. The generational wealth is very, very important. You've got, let's say your grandparents worked their whole life and they pass the house on to you, and you can't keep the home now because of the cost of getting insurance, or you're subject to a loss. We have been talking with the community development corporations here in Texas that are providing affordable housing. And like you said, Doug, they are running into huge, huge problems because they have federal requirements that they have to hit. And then you've got state insurance that they can't obtain at a price point to cover those properties. And then we're seeing this across Texas in our cities, just like across the country, a homelessness crisis. Okay. And so we need to be doing everything we can to keep working families in their homes so they can be safe and productive citizens. Michael, I interrupted you. You were going to add a point.
Yeah, just really quick to follow up on what Doug said. In our report, we actually have a list of the top 10 states with the most uninsured homeowners. And Texas is at number 10 with 10% of homeowners lacking insurance. So 1 out of every 10 of Texans doesn't have homeowners insurance. And you would hope that elected and regulatory officials would be taking this seriously because it's affecting a lot of their constituents.
Yeah, and where I think this brings up an important point, and I think you feel the same way. At CFA, we spend a lot of our time criticizing the insurance industry and the regulators who oversee it. But I want to be really clear. It's not because we just don't like insurance. It's actually just the opposite. We deeply believe that insurance is a critical component of economic opportunity and community resilience. The reason we're fighting so hard to make sure that insurance companies are treating customers right, are competing in a fair market, and that regulators are ensuring that we have reasonable rates that aren't unfairly discriminatory, that aren't excessive, is because we want to make sure that people can be insured, can transfer some of that risk that comes with living in a modern society in a way that allows them to have that kind of equal opportunity that we want to see spread through the country. So I want to emphasize that, because I don't want people to misunderstand that, oh, well, it's just insurance is the problem. Bad behavior by insurance companies, weak oversight by regulators, lawmakers who bow to everything the insurance companies want when their lobbyists come with checkbook in hand. Those are the problems. But we want to make sure that people have that insurance. That coverage is critically important to the vibrancy of any economy. So I think that it's always important to keep that in mind. That's why we fight for this, because it's worth it.
That's exactly right. I've said it many times, and I will say it again here. We want insurance companies to make a profit. We want insurance companies to be in Texas and to insure risks. What we don't want is insurance companies to take advantage of their customers and make an excessive profit. And that's what we're all fighting for in the consumer community, is just making sure that these insurance companies are doing things the right way. The exposed report is so important. Again, we will put that in the program notes, and we will look forward to the updated report in the months and years ahead as you are able to obtain even more current data. But thank you for the deep dive that you've done in producing this report, showing again that over $1 trillion in property wealth is uninsured in this country. That is shameful. We can do better than that as a country. We've talked a bit about the pandemic and the effect that it had on our household budgets. And one of the things that I think a lot of people, even today, are surprised to learn is your credit score is heavily used by insurance companies. I mean, they even have their own models beyond the typical credit scoring models that we hear about with the credit bureaus that we know about. They have their own models as well that take that information about how we pay our bills and how many outstanding loans we have and other risk factors that they put into their black boxes, and they assign an insurance credit score to us. Again, through the pandemic, many families have been hit very hard about this. And as we're seeing rates go up, I think a lot of homeowners and drivers sometimes don't think to ask their insurance company, how are you using my insurance credit score? What does your model look like? How many tiers do you have on that model, and where do I rank? What can I do to improve my standing with you? In Texas, we have some protections on the books for folks if they've had what are called adverse effects to their credit, but it's incumbent upon you. The burden is on you as the consumer to tell your insurance company about that in writing and see if they can make an accommodation for you because of that negative event that happened in your credit history. We'll put information about that again in the program notes. But CFA has released yet another great report last summer called the 100% penalty, looking at the effect of credit scores on your auto insurance. And again, Michael, I know you focus a lot on auto insurance. Can you talk a bit about that report and your findings and what consumers can do as it relates to their credit and their insurance?
Sure, of course. We called our report the 100% penalty because we did a study of auto insurance premium data, which we got from a big data broker, and it's from fall 2020 on credit scores and auto insurance premiums across the nation. And we found that people with poor credit were often paying on average about twice as much, or 100% more, for auto insurance just because of their credit score, even if everything else about them was perfect. And about specifically referring to Texas, we analyzed the data, we broke it down state by state. And for Texas, we found that in the fall of 2020, a driver with a perfect driving record, 35-year-old driver, perfect driving record and excellent credit, they paid on average a premium of $399, which is pretty good. But if you take that same driver, everything about them stays exactly the same, except they only have fair credit, their average premium jumps to $641. And if you take that same driver and make it so they have poor credit, everything else being held equal, their average premium is $904. So they're paying about $500 more just because of their credit score, or 126% more. And it's important to also note this data is from 2020, so it doesn't take into account the recent really big auto insurance premium increases. So what people are paying now is significantly higher. And it doesn't affect people who may have more driving records where, say, they may have gotten a ticket or other things like that. And most people are unaware that your credit score can be used to charge you more for auto insurance. And when they find out, they're upset and believe it is quite unfair. You also mentioned that there is a sort of a process the insurance companies have where you could kind of complain about this. But again, that requires that you know that your credit score is being used to overcharge you and get you a higher auto insurance premium. Most people don't know that. You then have to complete a process. You have to jump through multiple hoops and provide evidence. And even if you do all that, there's no requirement. There's no guarantee, even if you complete everything, that the insurance company will reduce your premium. And so that is unacceptable. With regard to what consumers can do, we are working to try and ban the use of credit information and credit scores in auto insurance. The insurance industry really likes the use of this practice, and they're lobbying hard to keep it in place. In the meantime, it's well worth checking your credit report and determining if there are any errors, because a lot of credit reports have errors, sometimes big ones, and that can hurt you and penalize you in a lot of different ways. So fix that. And also, if you can, work to improve your credit score, because that could save you money on your car insurance.
Let me,
Doug, please.
Add in, there's a piece of data from our colleagues at Consumer Reports magazine that I think really homes in on what's wrong with the use of credit by insurance companies. I mean, let's put aside the fact that it has, what your credit score, whether or not you paid your Visa bill or how much of a balance you're keeping, has nothing to do with whether you're a safe driver behind the wheel. Put that aside, or the fact that you can protect your home and take care of your home even if you have some debt, right? Put all of that aside. The Consumer Reports, this is now going back a few years, but I've looked at more updated data, and it stays the same. Consumer Reports found in Texas that a driver with a perfect record but a poor credit score will pay about $1,000 more for a comprehensive insurance policy than somebody who has an excellent credit score and a drunk driving conviction.
Yeah.
So let me say that. Let me just say that again, because I think it's so critically important. The insurance companies that use credit score, and that's basically all of them, the insurance companies in using credit score use it to such a degree that if you have excellent credit but a drunk driving conviction, you're still going to get a better rate than somebody with a perfect driving history but a low credit score. I mean, this kind of discrimination against good drivers because of their financial condition is exactly the kind of outrage that should drive lawmakers to intervene and say, whoa, wait a second here. Are the folks in Texas who are doing everything they can to keep our roads safe, but are struggling financially, that are vulnerable to the economic conditions, they shouldn't be charged $1,000 more based on their credit than somebody who's on the road driving drunk and convicted of it. So I think what that shows is not just the things that make your blood boil, but it shows the priorities of the insurance companies. They're not concerned about whether or not you're going to cause a crash here or there as much as they are who you are financially. What kind of opportunity do you present to them? Because what they see in the person who has the excellent credit and the drunk driving conviction is not the danger to the road. They see that financial well-being that might buy more insurance product, that's likely to have a home that they could insure, maybe wants more life insurance, and hey, maybe will invest some of their money in their investment affiliate. These insurance companies use credit score to tag us all and slice us and dice us in such a way that they find the customers that they like and will give them special discounts. So that means that good drivers with poor credit are subsidizing dangerous people on the road simply because the insurance companies like their financial situation better.
Following up on that, actually, there was a post we did a couple of years ago about Progressive, where we found that they value customers who are more for their wealth and whether they have disposable income to buy additional insurance products compared to how risky they are. They classify their highest quality customers, the highest value customers, as the Robinsons. And these are rich people who will own their home and car and be able to buy auto insurance and homeowners insurance, and possibly if they're really wealthy, even like boat insurance and other things. And then they rank the other customers. These are most desirable, the Robinsons, then less desirable, and at the bottom are the people who are relatively poor and have less disposable income.
Yeah, the insurance companies, when they're talking to their investors, are very explicit about their strategy. Their strategy is to flood the zone where there's wealthy customers. Get there, give them the best rates, get as many of those customers as they can, and they do that on the backs of those who have to buy that auto insurance product, but they're not interested in them. So for those people who are struggling financially, who aren't the Robinsons, as it were, aren't the kind of ideal customers, they still have to buy a product. They just have less options in the market. So they pay more and subsidize the cheap deals that are given to people who fit the bill for the insurance companies. And I think that this credit scoring is just a prime example of that. And in fact, in around the country and in Texas, we see that credit scoring will just have such an impact on your rates that it is true. Shop around, try to get those things fixed on your credit score if there are problems. But really, we need protections from this kind of behavior. It's not going to be solved simply by the consumer alone. Lawmakers have to stand up and protect consumers from this kind of practice. The regulators should be investigating the companies and making sure that they're not playing games with their use of credit score, because they really have rigged the system to achieve what they want, even as the legislature makes us all buy that product.
We agree 100% at Texas Watch. Credit scoring has no place in insurance. If you're in between jobs and maybe you're behind on a bill a month or two, that has no bearing on whether you're going to run a stop sign or a red light. And the idea that you could have a drunk driving record and get a better insurance rate than somebody who's just working a family in the state of Texas with a clean driving record makes no policy sense at all. So thank you again for your leadership. And again, we support those efforts to make sure that insurance is actually focused on risk, and that we're not just penalizing people because maybe they're not rich enough in the eyes of these big insurance companies. I want to talk about a possible solution on the horizon here for this insurance crisis, again, of the insurance industry's making largely. It's a bill that's been filed in Congress. It's called the INSURE Act. And it would help to create a federal backstop here as it relates to some of these big catastrophe-related insurance claims that we've been talking about. It does a number of things. Doug, can you take us through the INSURE Act that's pending in the U.S. House of Representatives right now?
Yeah, thanks. As we've already talked about, American homeowners are facing an insurance crisis. They're struggling with double-digit price hikes. They're losing choices in the market. We're actually seeing the coverages that are offered become hollowed out. So you no longer have the full replacement cost value of your home. You're starting to get this. You're starting to get lower quality coverage available, and so we're seeing this real problem in the market, and it stems from the intersecting problems of climate-driven catastrophes and this high cost of unregulated global reinsurance that we talked about earlier. So the INSURE Act will improve homeowners' access to quality insurance coverage, promote risk reduction and loss mitigation, and it will be used to strengthen community resilience in a couple of different ways. First of all, this legislation would create a federal backstop that would diminish the market power of these unregulated reinsurers from Bermuda and Switzerland and the like, by essentially doing what we did in the wake of 9/11. After 9/11, the world's insurance markets kind of collapsed because the insurance company said, oh, we're not going to be able to insure these big high-rise buildings on Wall Street. We're afraid of terrorism, and we are not willing to take on that risk. So very quickly, Congress stepped in and created the Terrorism Risk Insurance Act, which actually did exactly what we're proposing now. So when Wall Street, literal Wall Street, the buildings on Wall Street were in serious crisis because they could not get insurance due to the reinsurance markets of the world shutting down for them, Congress took action and created a federal backstop that actually provides free reinsurance to the insurance companies that will go and insure Wall Street buildings. Well, now we're in a crisis of an even larger scale with climate change and climate-driven catastrophes. And so just like the Congress stepped in for Wall Street, we need Congress to step in for Main Street and make sure that we've stabilized our insurance market by taking away some of our reliance on the unregulated global reinsurance market. So that would be the first piece of it, making sure that anytime there's a mega catastrophe, the insurance company knows there's a backstop for them. They don't get it free under the INSURE Act, unlike the 9/11 approach. Insurance companies would have to participate in this program and pay a premium, but it wouldn't be the kind of unregulated premium we see out in the global markets. It would be much more responsible and not for profit, as a starting point. But the law does more than that. It also creates funding for investments in community safety and resilience by putting billions of dollars towards the kind of mitigations that will make our homes and communities safer, so it will reduce the overall risk. Now, I understand that people don't like spending money, but you have to remember, for every dollar that we spend on mitigation as taxpayers to prevent losses, we save $6 to $7 on after catastrophe recovery costs. By putting the investment up front, by actually doing what we need to do to lower risk, we save a lot of back end money. So it's a net win when you make those investments, and the INSURE Act would make investments towards making our homes safer and our communities more resilient.
And when we're talking about mitigation, because it's kind of a term of art, we're talking largely about hardening our structures, being smarter about how we're building and developing our properties. So tie downs in your roof can help if you have a big windstorm. Making sure that you're keeping brush cleared away from your property can help if you've got a wildfire threat. It's that sort of very practical, those practical upgrades that we can make in protecting our properties.
Yeah, that's absolutely right. Actually, there's been a lot of good science that has identified precisely the kind of roof that we need to address kind of the windstorms that come through. We have done the work on the science side, but it costs money to strengthen our homes and fortify our roofs and the like. And it's difficult for people in any financial time, especially now, to go ahead and make those investments. We need to do that together. We need to come together and make those investments and share in that effort for all of us, not only because we want to protect people's lives, but by having safer homes, we lower the overall cost in the insurance market, as well as we reduce the cost of emergency aid after a catastrophe. So that type of mitigation and home hardening, we like to call it, is really critical. But then a third piece of this INSURE Act, which is the kind of the final part of it, is that we would change the way homeowners insurance is provided in America. Because right now, and in Texas, you know this quite well, is your homeowners insurance policy doesn't cover all of the risk that you have. Putting aside whether or not your deductible is too high or you're no longer getting the replacement cost, you're only getting a depreciated value if you have a claim, you actually have to buy a separate policy for flood insurance. In a lot of counties near the Gulf Coast, you're having to buy your wind policy, maybe through the windstorm, the Texas Windstorm Association. So we have to buy all of these policies. And as a result, a lot of us are exposed to, for example, a flood that we just don't have coverage for. And so what we'd like to do is we'd like to put the insurance back into a homeowners insurance policy. And with the INSURE Act, for insurance companies to access this great benefit of a low-cost reinsurance system, they would have to start selling a policy that actually covers all of the risks. It would eventually sort of move us out of the use of the National Flood Insurance Program, which is a public flood insurance program that covers most flood in America. But unfortunately, it doesn't cover most flood because most people don't buy it. And it would put that flood insurance back into our policies. And so that would be a great way to do a couple of things. One, it would spread risk much more broadly because everybody would be covered for flood. It would allow us to actually recover when floods come through our communities. And it would lower costs overall because right now it's so inefficient to have to go buy 3 policies. Not just difficult for us to manage, but it's inefficient because we're paying administrative costs 3 separate times. If that's all in one policy, we dramatically lower the cost of providing insurance. So with the INSURE Act, we have the key federal components that can be taken care of. But of course, insurance is regulated by the states. So even if we get this in place, and we certainly should, we're still going to be counting on the Texas Department of Insurance and the Louisiana Department and all the departments of insurance to take up responsibility for holding these insurance companies to account, to make sure that they justify rates, that they're not providing us premiums that are excessive. We need to be working together. For so long, the insurance industry has looked at all the great data that they have, and they've used that to pick and choose, figure out what's best for themselves, even at the expense of all of us who've been paying premiums to them for decades. It's time that the insurers, the regulators, communities, and consumers are working together to address the climate crisis and the premium crisis that so many of us are facing, both in our home and auto insurance. There is an opportunity to work together. We've got the Federal INSURE Act, and we've got groups like Texas Watch working day in and day out in the legislatures around the country to bring some sensible solutions to our insurance market, because it's time for reform.
It's a really important bill that's pending in Congress right now. It's a very balanced bill, and it's time for America to step up and protect Americans. I'm thinking about how we're basically energy independent now in America. We can power our own country, given all of our energy resources. Why should we be subject to the whims and the mercies of a Swiss reinsurance company or a Caribbean-based reinsurance company when we can do this together as a country? And so that's what the INSURE Act does. It's America protecting Americans, pooling and spreading that risk because that's the fundamental purpose of insurance. We pool and spread risk so that insurance is available, it's affordable, and it's adequate. That's the whole point of insurance. So we can come together as a country and take care of our risks and spread that risk here in America and not be subject to the balance sheets of reinsurance companies overseas. Doug.
You make a really important point, because one of the concerns that I've heard when talking about the INSURE Act is, well, you're creating this new reinsurance system because there's a crisis over there in California or in Florida. Well, actually, really important that we need to get the data straight. The truth is that catastrophic risk, both climate driven and just broadly speaking, catastrophic risk, the stuff that costs insurance companies so much, is really most severe through the middle of our country. From the north of Texas straight up the middle of the country is where we have the vast majority of catastrophic losses in the country. This is always surprising to people when they look at it, but the amount of windstorm and hail losses is somewhere in the range of 8 to 10 times more the average annual losses for wildfires in America. And what that means is not that it's one part of the country's problem or another's. It's that it's all of our problems. We do have to be in this together. This is a national battle that we have to fight. And I think it's really important that we don't think about pitting consumers in Texas against consumers in Florida, against consumers in California. The fact is, this is happening all around the country. Minnesota has had hailstorms and windstorms that cost that state $1 billion, right? Some of the highest home insurance premiums in America are in Oklahoma, right? So this is a national crisis, and we need to be fighting it together.
Most definitely. As somebody who grew up in Fort Worth, Texas, I'm well acquainted with those windstorms that we get there in the tail end of Tornado Alley, and we're all in this together as Americans. So we should have each other's backs. We're our brother's keepers, really, as Americans. While we're talking solutions here in Texas, the insurance companies have tuned up our insurance laws into their preferred system, which is called file and use when it comes to rates. So they can file their rates, and it's left up to the Texas Department of Insurance to chase them down if there's a problem with what they want to charge Texans for their insurance. We've had that system in place almost now for 20 years, and what we've gotten through that time is higher rates and less coverage. So we've done it the insurance company's way, and we as consumers have been suffering, I would say predictably, because of this insurance-oriented system that we have, or insurance company-oriented system that we have. Doug, can you talk about the main alternative to that system, a system called prior approval, and what that would mean for consumers in this state?
Yeah, so file and use, the system that you have in Texas right now, is a recipe for insurance companies asking for forgiveness rather than permission. But what we've learned, of course, is that they never come in and ask for forgiveness even. The problem with a file and use system is insurance companies, they set the rates that they want to charge for all of us who have to buy their product. They go into the market with it. And at some point, if the Texas Department of Insurance goes in and looks and finds some problems, they call the company back in. Under a prior approval system, as the name implies, insurance companies have to justify rate changes before they can take effect. They can't just go into the market and hope nobody notices. They have to go to the Department of Insurance and say, here's the actuarial data that supports our change in the rates. And only if they can prove up their need for rate increases and the way they want to slice and dice the market to prove that it complies with the state law, to prove that it's not excessive. Only then can they go with new rates. And we've done a study. We've been doing a study for over the past 15 years, kind of on an ongoing basis. And what we have found, using the auto insurance market as our test case, is that those states that use a prior approval system see dramatically lower rates of increase over time than those states that use file and use, or the even more deregulatory use and file system, in which the companies just eventually pass share their documents with the Department of Insurance, but they're making changes as they want. But what we found was that those states that use that prior approval, that system of justification before going into the market, do much better for protecting consumers from the dramatic rate increases that people are facing. And it's borne out not just in the data, but in the pocketbook experience of Texans who are dealing with, as you pointed out, rates that are increasing at kind of twice the rate that we see across the nation. And so if you want to do something about the high rates of insurance, well, yes, we can fortify our homes and make them safer, lower risk. We can we can do it, shop the market and find some price savings here and there certainly are. But what we really need to do is to ensure that the companies are undergoing the scrutiny that is required of a market in which the demand side, us, are forced to buy their product. It's as simple as that. If you're going to regulate our behavior and tell us what we have to do, then we need to put a stronger kind of magnifying glass on the insurance companies' rates and practices before they come into the market and charge whatever they want.
Most definitely. We've talked about solutions at the national level, at the state level, with a system that would really protect consumers a lot better. Let's bring it down to the consumer level. What can we do as individuals, as families, to get a better policy at a better price? Michael, I want to come back to you on auto insurance. And here in Texas, the auto insurance market is several times larger than the homeowners market, more cars than homes in this state. And I'm sure that's the case in every state. But what's some advice that you would give to drivers in terms of what they can do to get the best fit in terms of a policy at the best price?
There's a good question. There's a whole bunch of things you can actually do. First off, shop around. This is our advice to everybody, and it's especially important now. It's well worth your time to sit down, try and get some online quotes from a different bunch of auto insurance companies from their websites. For example, if you find one company that charges you $120 monthly in your premium, and you find another company that charges you only $90, you've saved $30 per month, which adds up to $360 per year, which is pretty good for maybe a couple of hours or so. You can search in multiple ways. You can go to the websites and put in the information yourself and get the quotes, which we recommend. You can also use some of these like aggregate websites like the Zebra and other things, which can easily produce quotes for you. However, you should be aware these websites don't look at all the companies and the various options, and they are also often funded by the insurance companies, so they have their own agenda there. You can also use an agent, which can sometimes be quite helpful if the agent is knowledgeable, knows what they're doing, and knows about possible options like, say, maybe smaller insurance companies or local companies, and that can offer you a better deal. Other tips, we've already mentioned that you can try to improve your credit score. We hate having to tell people this because your auto insurance premium should be based on your driving record, not your credit score. But while it is, try to find your credit report and fix any errors and work to improve your credit score. Other things, ask about discounts. For a lot of auto insurance companies offer discounts like, say, a paperless discount, a discount if you've served in the military, a discount for students, and you should take advantage of them at every turn. Call your insurance company and if you're driving less, and make sure they know that. They may be able to they may lower your auto insurance premium. Like, say, if you are only driving to the office, like, say, 2 or 3 days a week as opposed to 5 days a week. And if you are feeling that you are being mistreated by your insurance company, you shouldn't hesitate to file a consumer complaint with your Department of Insurance, because their job is to make sure that insurance isn't too expensive and to correct any abuses. You can Google them, like, say, Texas Department of Insurance. They will have a form that you can fill out. Please include as much information as possible and follow up with a call. And it's their job to actually try and help you. So, and Doug, anything else you would like to add?
Well, no, Michael's given some great advice. I think a couple of things to just note, especially as we think about the home insurance side of it. There are some important things to think about. Obviously, we all are looking to save some money, and that's important to do. But we have to remember and just gauge what you give up. It's not like moving from a name brand cereal to a generic cereal, and it's basically the same thing, just different packaging. If you start reducing your coverage, what you're doing is you're transferring risk back to yourself. Mm-hmm. And so when you do, especially with a homeowner's policy, if you're increasing your deductible, same with a car, but if you're increasing your deductible, or if you're moving from one of those replacement cost policies that have been traditionally, which will pay to kind of repair your roof, to something called an actual cash value policy, which a lot of insurers are pushing us into now, they're going to depreciate the value of a claim. And so if you have a 10-year-old roof, you're going to get much less than you would in a normal insurance policy. So I just warn people, I understand you got to make that decision. I can't really account for what might happen if there is a catastrophe, but I can account for what I can afford next month. So I understand it's really important to create savings, but just make sure you understand what you are giving up when you lower those coverages, and be honest with yourself about owning that risk. So for example, with your vehicle, you may no longer have a loan on your car, so you don't need to buy comprehensive and collision, which is required by your auto lender. Well, that's fine. If you want to cut that, just know that means if your car gets stolen, or if your car gets damaged and there's nobody else was at fault, then you don't have anybody to replace that. So make sure you're putting money away for it. And we do a sort of a little thumbnail that if the value of your car is less than 10 times the premium for that comp and collision, then it may be okay to drop the comp and collision, but just make sure you're putting money aside in case you have that terrible situation where your car gets stolen or your car gets totaled and you can't, and you need to go buy a new one. So it's just really important for consumers who are making these decisions as we struggle in this insurance market, to know what we're giving up when we give up that when we go for lower coverage. Now, the other thing I would just add, I want to amplify. Michael said, in addition to all the shopping that we should do, if you're seeing a problem, complain to the insurance department. We need to let our lawmakers know how frustrated we are with this market. So yes, take the time to shop around, but add a little bit of time to call your local representatives and let them know that you're upset. Because one of the things that we find when we go into legislatures around the country is politicians who say, well, I haven't heard anybody complain about this problem or that problem. Now, we need to let them know how frustrated we are with the insurance markets, because that puts the pressure on lawmakers to take action. And we have seen that make a difference. When the lawmakers know that we're scared that we're going to lose our auto insurance, or where we're getting a low quality home insurance, that's when they're thinking about it. And that gives consumer groups around the country the opportunity to speak up and help define the way real reform should happen.
Those are such important tips. Thank you to both of you. In Texas, we're fortunate to have a policy comparison tool that the Office of Public Insurance Counsel creates and maintains, and they're doing a great job over at the Office of Public Insurance Counsel, that takes different insurance policies and they group it by coverage type, and they put it in plain language. It's not written in that legalese that you see in a lot of the contracts themselves. And so we highly recommend that tool. We will include a link for the Office of Public Insurance Counsel's policy comparison tool. Say that 5 times fast. That's a great resource. There's also a website that the Office of Public Insurance Counsel and the Texas Department of Insurance jointly maintains called Help Insure, that can help you see insurance companies that are writing policies in your area. You can search by zip code on that. That's a great resource as well. Again, we'll include a link to that. Michael, you mentioned insurance agents. They can be a help to you. We recommend people talking to independent insurance agents who can help to shop a number of different companies and carriers at a time and get different quotes for you. And then both of you mentioned discounts. Talk to that insurance company when you're pricing them, see all the available discounts. And if you feel like that company is going to treat you fairly, sometimes you can get a discount. Oftentimes you can get a discount if you bundle both your homeowners and your auto insurance together. And so that's a question to consider. Doug, you had another point.
Well, it's just this is something that I tell people when people call me up and ask me for some advice. They say, well, I've been with my company for a long time. and I get a loyalty discount. So, I don't feel like I can shop around. So that's a strategy the insurance companies use to keep people with them, but mostly to keep them from not shopping. Because what we find is that you may be getting a loyalty discount from your insurance company who's overcharging you. And so it's like those cards you get for the supermarket, and you'll get 10% off if you use the card. It's really just that they're overpricing the product by 10% beforehand. So the insurance companies, they sell you a 6-month policy or a 1-year policy. That's how long they are dedicated to you. We should not be more dedicated to them. And just because we're getting a loyalty discount doesn't mean there might not be another insurance company that will just charge us a lower rate out there. So don't be afraid to shop around. In fact, the insurance companies have a system that they use to kind of optimize prices in some states. Now, fortunately, a lot of regulators have said you can't do this, but they want to optimize your price. And if they think you're a shopper, they'll give you a better deal than somebody who's not a shopper. And so it's important that we show those insurance companies that we're not afraid to shop around and not afraid to walk away from their so-called discount when another company might be offering us a better deal. So that's a really important thing. And in fact, one of the things we're seeing in the trade journals over the last couple of years is that the companies are kind of freaking out that people are actually doing that shopping. That's not what they're supposed to do. Insurance is a weird business. The market is not driven as much by price as it is by advertising, and who people remember and who they laugh at, and which sports figure is supporting which companies. If you shop around, the price differences can be quite amazing. It's really not a competitive market on price. It's competitive on this advertising, and they tell us we should only shop for what we need. I say we don't need all your advertising money. We got to go find a better product at the better price. So I just think that shopping is definitely important, but you'll never find me saying that that's enough. We need protections in this marketplace. We always
most definitely. Just on a personal note, my family had been with an insurance company since the 1950s. It's an insurance company that does some advertising, and I took my own advice and we shopped the market. We're now with a much smaller insurance company, but a highly regarded one that doesn't do a lot of advertising. And we're very happy with the level of service that we're getting. So, we were loyal dating back to the 1950s, but they weren't doing right by us in the 2020s. And we made that change. And so this has been a very deep conversation, a very wide ranging conversation. We thank both of you for everything that you do for consumers all across this country. Again, I can't say enough good things about the Consumer Federation of America. Y'all lead the way. I highly recommend everyone listening to this interview to check out CFA's website, consumerfed.org. We will include that as well in the show notes. And Doug and Michael, I look forward to the next conversation because I know we have more to talk about here in the months ahead.